All right, everybody. Appreciate your patience. I apologize for the delay. I want to thank everybody for joining us today. My name is Patrick Swain, and I'm the Regional Vice President for the Thompson Agency. Today, I'm going to be discussing why permanent life insurance should be a part of your client's protection strategy. So first of all, this presentation is in no way intended to sell against term. Instead, my goal is to show you how to position permanent life insurance to fulfill a client's wants, whereas term mostly is used to satisfy a client's needs. So this is going to be the first monthly sales starter webinar, the first of many presentations that the Thompson Agency is going to be holding on the first Wednesday of every month. So we'd love to hear your feedback. Hopefully this presentation brings strong value to your practice. And we'd love to hear ideas on what you'd like to see moving forward. So really, this is all about you guys, and I hope you get something out of it. Oh, bear with me one second. So when we talk about fulfilling needs, we are most talking about income replacement, mortgage protection, college funding, and low-cost alternatives to permanent while a client waits to convert, and also being able to guarantee the client's insurability. So we definitely know that term has its place, and it does a very efficient job of covering these needs. So before I move on, I just want to establish that there is definitely a place for term, and it does satisfy those needs very efficiently at a low cost. So one of the biggest objections to acquiring permanent insurance is that the client won't need any life insurance once their children are grown. And although that may be true, shouldn't that same client be asking the question, is saving or investing towards these wants the most efficient way? An analogy I always like to use is a client could use a hammer to build a house, but wouldn't it be more efficient to use a nail gun? Life insurance, permanent life insurance, is just another tool to help a client accomplish their financial goals. So let's talk about some of the things that permanent life insurance helps accomplish. First of all, final expenses. This is something that every client is going to have to deal with when they finally do pass. The average funeral costs about $14,000. In addition, they may want to cover some other needs, debts, etc. So permanent life insurance can help satisfy these needs. Also, wealth transfer, the ease of wealth transfer, estate taxes. Although estate taxes is not going to affect the majority of our clients, there could be a federal or state, and usually state inheritance or state estate taxes have a much lower exemption. Just as an example, Connecticut has a $2 million exemption. And that's combined between husband and wife. So there's no portability. If their total estate equals $2 million or more, or I should say more than $2 million, the amount above $2 million, it gradually gets a larger and larger state estate tax. Also, equalization. Many of our clients have estates that are illiquid, and they might have multiple heirs, multiple children. What is a client who's worth $2 million who has a $1.8 million business? So they don't have many liquid assets, but the kids don't want to manage the business once they actually pass. Certainly they could do a forced sale of the business to help equalize their children and leave money to their heirs. But an easier way of doing it is buying life insurance and creating a more liquid estate for the children. Also, and I'll go into greater detail on this, is looking at life insurance as an asset class, and this specifically the death benefit as an asset class. And also providing a living exit strategy for buy-sell planning. Our business owner clients, most of the times when they're planning for a buy-sell, they're just looking at what happens if one of our partners dies. How do we buy out their interest so we don't have to work with a family member and make sure that they're taken care of? Well, term's great for covering that need at a low cost, but what if they live, which is more likely, or what if they become disabled, which is also more likely than death while they're in the business? What we can do is look at using an overfunded IUL and potentially providing a living exit strategy. Maybe it doesn't take care of the full need, but it provides them options, which term is low cost, but it really doesn't give them any flexibility to accomplish those other ends of the buy-sell. And lastly, executive benefit planning. So this is just providing for those key executives within a business where 401ks and qualified plans aren't going to satisfy their full retirement need. We can use permanent life insurance to, number one, provide a deferred comp, executive bonus, or even split dollar strategy. So let's look a little deeper as to why permanent insurance makes sense. So the alternative to buying permanent insurance is to self-insure. This usually means buying term and investing in a side fund. The pros would be the potential to achieve favorable returns. Also, you are able to keep the cost of the insurance down while freeing up money for other needs. So that's the pros. The cons of this approach is that the client is taking on all the risk. In order to achieve favorable returns, the client has to be subjected to volatility. There could also be a shortfall in coverage after term insurance terminates. And lastly, lack of long-term care coverage could and this could be traditional or hybrid long-term care, or even add a long-term care rider to your client's life insurance policy. But not having that coverage could slowly evaporate savings, no matter how large that savings is. So the average cost, just so everybody knows, to stay in a nursing home facility is approximately $90,000 per year, while assisted living is approximately half that. So in today's market, there are numerous permanent life insurance products that add additional flexibility by allowing the client to accelerate the death benefit if they satisfy 2 of the 6 ADLs or can't perform 2 of the 6 ADLs. So it does add some nice flexibility with adding one of those riders. So what does it look like to buy permanent versus buying term and investing the difference? Well, let's go ahead and take a look. So here we have an example of a 50-year-old male, standard non-tobacco, who's looking for $250,000 in coverage. Now, bear in mind, we'll just assume that the $250,000 is a permanent need, and they're trying to determine whether, buy term and invest the difference will satisfy it, or if they could just buy permanent, what makes more sense in the long term. So here we have a chart that looks out over the next 55 years. Remember, this is a 55-year-old male, so that brings him out to 105. And it does a comparison between those two approaches. The green line here indicates permanent insurance. And you'll see that it goes up over time. And the reason that it does that is I used a Lincoln Wealth Advantage IUL for $250,000 in coverage. But I illustrated a premium that was a little bit more than what the minimum premium would be. And that premium is $4,700 over 15 years. So this allows the client some upside potential and also some leeway should the S&P 500 not perform as expected. The black line represents buying term and investing the difference. And we're assuming a 6% side fund rate of return. So as you can see in the early years, the buy term and invest the difference does slightly outperform permanent insurance. However, after the level term period, the side fund has not been built up enough to provide enough coverage. So even in later years, the death benefit on the IUL starts to grow and even keeps pace above and beyond what a side fund of buy term and invest the difference provides. Keep in mind, all the money in the IUL is tax deferred, whereas this investment is going to be taxed year by year. Also, what do you get with an IUL? You get downside protection. On this product specifically, a 1% guaranteed floor. It may vary between carriers, 0 or 1, and caps may vary as well. So that's just something to keep in mind. So let's look a little bit into the numbers. So here are the assumptions that we use. And please note, there are numerous carriers to choose from, and we could have easily used a guaranteed death benefit solution. But the solution is really going to depend on what your client's goals are. For younger clients who are not risk adverse, going with a non-guaranteed death benefit would mean more cash accumulation potential. And as you can see, even at a 1% guaranteed floor and current cost of insurance, this design would last till age 82. So right around life expectancy on a more realistic worst case scenario. Again, the 1% floor in current COIs. And I just want to mention that for those clients who, may just need permanent insurance for final expense needs, we do offer 4 different carriers that offer guaranteed issue or simplified issue. And those would be Transamerica, Fidelity, United of Omaha, and Kemper. Kemper being the guaranteed issue option. So just so everybody knows, there is options for lower face amounts on final expense type policies. So let's look a little bit behind the numbers. So here's the assumptions that we use. And please note, so let's look a little bit behind the numbers. And here's 3 bullet points to cover. You can see after the 15-year level term period, obviously your death benefit falls off. They would have the option of converting, albeit at a much higher premium, but your side fund has only grown to $82,000. Just a note, in the IUL at a 6% rate of return, you actually have $78,000. So that's money accessible for certain client needs, distributions for college funding, maybe just money for a rainy day. But the point is, client has equity. And remember, we didn't fund this at a minimum premium level. So there is some leeway, even with lack of performance. Also, because I overfunded it slightly, the death benefit in the IUL actually starts to grow at age 89. So you could see that at age 89, I know these numbers are a little small. You could see it goes from 250 to 256,000. So there's some great opportunity there to kind of counter inflation. That $250,000 death benefit isn't going to be worth what it is today 40 years from now. So you have some growth potential of the face amount. So again, I just wanted everybody to see the numbers on, how buying term and investing the difference doesn't always equate to better results. Certainly, if we're assuming a higher rate of return and the client feels that, they're not risk adverse and they could achieve that, these numbers might look a little differently. So each case is going to be a little different, but at 6%, I feel that's pretty reasonable. And what most people ask me for when they have me run IULs. So what else are you getting with permanent insurance? You're getting a lot of flexibility. Number one, the actual paying of premiums is flexible. Even with guaranteed UL, you can make up premiums and reinstate the guarantee through maturity. And cash value products, the cash can cover the monthly charges and cover the COI charges. So that's one thing. Also, what if better products come out? For those younger insureds, interest rates have remained low. These are not the best guaranteed ULs that we've seen. 10 years ago, I would argue we're more competitive priced GULs. What if we return to a higher interest rate environment and the client has a good amount of cash in the policy? We could 1035 and improve the client's situation. Also, just cash value available for distributions. In the past, policies, it was just take withdrawals or take loans, and the withdrawals were to basis. Loans were fixed loans. There wasn't a tremendous amount of leverage, but now we have the opportunity to take advantage of participating in variable loans. More aggressive, albeit, but more leverage there as well. And also adding those long-term care chronic illness riders. So as I mentioned earlier, if the client can't satisfy 2 of the 6 ADLs or they have a severe cognitive impairment, we can start accelerating anywhere from 2 to 4% of that death benefit on a monthly basis, tax-free. So we're probably going to have another presentation that goes into the different long-term care solutions. But again, I just wanted to kind of mention that as a flexible tool on permanent policies. So again, term insurance is low cost and definitely serves a great purpose. I'm not putting it down, but I think we have to look at reasons why permanent insurance should be entertained. So what if you have a client who's well off and thinks they don't need permanent insurance? What if they thought of the life insurance death benefit as just another asset class in their portfolio? Many of these clients have a portfolio of assets earmarked for their heirs. The return and risk of these assets is going to vary by what type of asset class it is. And in looking at this chart below that looks back to 1991 through 2015, we could see all the different types of asset classes: treasury bills, bonds, stocks, real estate, and commodities, and their corresponding risk or standard deviation. The higher percentage there, the more, the returns vary from the mean. So you could see, for instance, with real estate, the geometric return is more accurate because it takes into account sequence of returns. But you would have averaged 11%. That's great. And certainly the client could have a large portion of their portfolio there. But what if they experience another 2008? They don't know when they're going to pass away. Would the client appreciate if their $1 million of assets got depleted down to $600,000 because of another 2008 type year? Probably not. If they care about their heirs, having a percentage in permanent insurance is going to help mitigate that risk. So that's the whole point, is what if we could allow them to still achieve favorable returns, but reduce that risk? So that's where life insurance can be strategically used to diversify a client's portfolio. So how does a client tell how effective their life insurance is? Well, one thing I always try to include in every illustration is the internal rate of return. And the internal rate of return is a metric used in capital budgeting, measuring the profitability of potential investments. It will tell the client how much leverage is provided by the life insurance year by year, depending on when they pass away. And, when they die, that will determine how high or low the IRR is. They die early on before life expectancy. There's a tremendous amount of leverage. Not that we want that to happen, but it certainly could, and you have to plan for that. If you die after life expectancy, that internal rate of return usually decreases. So in life insurance, the client has the potential of receiving an attractive rate of return without having it correlated to the market. So a very effective way of selling permanent, where a client doesn't feel that they technically need it, and they very well may not need it, but it might add some value, it might add some protection to leave money to their heirs on a less risky basis. So let's take a look at the leverage of permanent life insurance. Here we have a 52-year-old female trying to determine the economics of buying a $200,000 guarantee UL. She's standard risk, and 6% would be her expected rate of return. So, and that was determined just, let's say, from discussing her retirement planning. She feels 6% is achievable in the market long term. So for $200,000 of guaranteed UL, her premium would be $2,281 per year. That's a lifetime level pay premium. So if she invested that money and earned 6%, she would not reach $200,000 the insurance is providing until age 88, which is 1 year after life expectancy. So can the insured guarantee that they will live this long? Of course not. Can they guarantee a 6% rate of return? No. If they could, that would be fantastic, but they can't. So by using a guaranteed UL, they can guarantee the IRR. They just don't know when they're going to die. So at life expectancy, they'd be receiving an IRR of 4.64%, tax-free. So assuming a 25% tax bracket, that equates to a 6.18% pre-tax rate of return. And by using GUL, the risk is removed, and we really didn't sacrifice return. I mean, unless they just want to be totally risky and they feel that 8 to 10% is achievable, we might have a tougher argument. But I feel like still having a portion in permanent life insurance, assuming they're favorably underwritten, could provide great value. So term serves a great purpose, as I keep mentioning. It allows clients to acquire coverage for needs that are large, such as mortgage protection, income protection, debt protection, college funding, things that are going to go away over time. It's a cheap way of covering those things, and term insurance should be used to cover a lot of those needs. But the likelihood of a claim being paid is very unlikely. So we can see that age 72, which would represent the coverage period for a 20-year term policy on this 52-year-old, the probability of death is 7.01%. And that's assuming a standard risk class. Obviously, preferred plus, you're adding on a few more years there at the very least. So term is great for covering these short-term needs, which are larger, but what about the client's wants? Do they want to leave a legacy? Would they prefer that a portion of what they leave to their heirs is not invested in the market, but still provide similar upside potential? Would they prefer to leave a tax advantage asset versus non-tax advantage? For wealthier clients, would they rather cover estate taxes by being forced to sell off assets, taking out a loan? Uncle Sam demands his money in 9 months. A lot of the states demand it in 6 months. So that's a quick time frame for turning around and selling off an asset, being forced to sell it. You're probably not going to get the full value. Or having a lump sum death benefit that is guaranteed. So these are all questions that should be asked. So even if term is the one product that you sell, I do want to bring up this point. Make sure to at least look at the best options for conversion, because nobody cares about conversions until they're unhealthy and they can't acquire insurance anymore. Having a term policy or term carrier that provides strong conversion options is going to allow your client to convert into a permanent policy without proving insurability again. But more importantly, it may allow them the breadth of that carrier's portfolio. Whereas some carriers might only allow one product that's not very competitive. So just something to keep in mind there. So what wants are we trying to accomplish with permanent? First of all, legacy planning and final expenses. I think it's great to have that. No client has ever complained about receiving a death benefit check, especially in a tough time where they just lost a loved one. I hear more and more from brokers who tell me how much satisfaction they get from seeing how happy an heir is when they lost a loved one, and they're not going to have to be financially burdened. They're already emotionally burdened, but at least we can help them financially. And also the asset diversification part of this. Stop looking at life insurance as just this thing that helps you if you die. Look at it as the death benefit as part of the client's portfolio. This strategy has revolutionized the way they sell life insurance in Merrill Lynch. I came from Lincoln, and in Merrill Lynch, they didn't sell a lot of life insurance. But as soon as they saw what it could do, as from a leverage perspective and a taking away risk perspective, they started selling it. And also its tax advantages. As it stands now, it's still a tax-free death benefit, whether it's a MEC or not. It's tax deferred. And if it's a non-MEC, it's tax-free income, even over basis if the client takes loans. And lastly, for those richer clients, focus on estate tax planning, whether it be federal for the really wealthy clients. Remember, it's about $10.9 million exemption between a married couple, or for state. Connecticut has that $2 million exemption. A lot of clients probably fall into this category. We can run an analysis here at the Thompson Agency for you and see what their need would be. So lastly, I think the goal of this call should be, try to think of 5 clients who you could call today and sell permanent insurance using this type of positioning. I think this gets around a lot of client objections, and you have to believe this in your head before the client will believe it. That's number one. If you don't believe it, they're not going to believe it. So with that, I kind of went over the time.